There's no free lunch. That's perhaps one of the most well-known statements in the world of personal finance and economics. And it's been proven true over the years. There's virtually nowhere you can go to find free money without there being some sort of trade-off, either immediately or down the road. However, there are some things that come pretty darn close. Intelligent diversification with regular rebalancing is one of those things. A well-diversified portfolio that's regularly rebalanced can often generate better risk-adjusted returns than its component parts. Depending on the time period you're looking at, it can also sometimes actually produce better returns than any of the individual investments within the overall portfolio. And believe it or not, in some very rare circumstances, it can even generate returns seemingly out of thin air. Now, I know how ridiculous and implausible that sounds, but if you're willing to stick with me for a moment, I'll show you how it can work as we explore how intelligent diversification with regular rebalancing can improve your chances of reaching your financial goals. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. In order to explore how regular rebalancing can essentially give you a return bonus, we need to understand a few things. The first is that there are multiple ways to measure returns. The two most common ways are the arithmetic mean and the geometric mean. An arithmetic mean return is very simple to calculate. All you need to do is add up the returns you earned from each period and divide it by the number of periods. Pretty straightforward. So if you earn 5% on your investments in your first year, 12% in the second, and 7% in your third, you'd simply add those returns up, divide by 3, and you get your arithmetic mean. In this case, our returns add up to 24%, so our arithmetic average would be about 8%. However, due to the math behind compound interest, the actual growth we see in the value of our investments wouldn't actually match the 24% figure that we would expect to see. It would actually be nearly 26%, since the second and third years would be growing from a larger starting base, as you can see in this chart depicting the growth of a $100 investment. The geometric mean accounts for this compounding effect, so in the real world, it's much more relevant when we're trying to measure the growth of a nest egg over time. The second thing we need to understand is that volatility can erode some of our overall returns, again, just due to how the math behind compounding growth works. Let's modify that last example a bit to show you what I mean. What if instead of earning 12% in the second year, we actually lost 12%? How would that affect our overall growth? As it turns out, our gains are completely wiped out due to the volatility that our investment experienced. This mathematical phenomenon is known as volatility drag, and it's something that every investment experiences to some degree. It's why the actual compounded returns we experience with our investments almost always end up being lower than the arithmetic average of the returns we earned each year. So keep those two things in mind as we go forward. The growth that we experience in our investments is strongly influenced by both the average returns those investments generate and the volatility they experience while generating them. With that being said, how could we possibly get a return-related boost simply by regularly rebalancing our investments? Let's talk about it. Let's say that you were picked to play a simple coin flip game. You'd put down some money, say $100 just to make things simple, and then call the toss. Every time the coin came up heads, you'd double your money. Every time it came up tails, you'd lose half your money. Assuming you were flipping a fair coin, probability would suggest that roughly half the time the coin would come up heads and the other half it'd come up tails. Therefore, over time, you'd expect the value of your investment to trend more or less sideways, as shown in this chart. However, what would happen if you regularly rebalanced your money in such a way that you only ever had half of your available funds invested in the game while keeping the rest of your cash on the sidelines? In theory, the cash sitting on the sidelines is also earning absolutely no long-term returns, i.e., just like the coin flip money, its general trend is sideways. And in a vacuum, that's true. But when you combine these two pools of money, their interaction tends to produce positive effects, even though both individual investments are earning zero returns on average over the long haul. Check out this revised chart to see what I mean. As you can see, the first flip came up heads, so we doubled the portion of our money that was actually on the line for that game. This left us with $50 on the sidelines and $100 invested in the game. Before the second flip, we rebalance our funds so that once again, half of our now $150 net worth was kept on the sidelines in cash. Unfortunately for us, the second coin flip landed on tails, so we lost half the money that we had in play, which amounted to about $37.50 in this case. As a result, our ending net worth after two coin flips sat at $112.50. Before the third flip of the coin, we follow the same procedure. rebalancing our money so that half of it is kept on the side in cash. But I want you to take note of something here. Even though at this point we've experienced one win and one loss, we've actually increased our net worth from where it was at the start. And over time, the trajectory of our net worth continues to rise. This is how regularly rebalancing our investments can give us a boost in returns, and possibly even effectively create returns out of thin air. The reason this works is because you're decreasing volatility drag more than you're decreasing your average returns. Of course, in the real world, investments don't rise and fall by a static amount each year. So how can we apply this concept to our real world investments? The answer is that you use the insight that regular rebalancing can raise the floor of your returns by reducing volatility drag to your advantage. For instance, say that John was 40 years old and just getting started on his investment journey. He wanted to retire by 65 and was able to save roughly 30% of his $50,000 a year income. Assuming he wanted to maintain that standard of living in retirement, what kind of inflation-adjusted returns would he need to achieve in order to reach his goals? Well, if we assume that he's following the 4% rule for his withdrawals, which states that you need roughly 25 times your annual expenses put away in order to be considered financially independent, he'd need to amass a nest egg valued at around $875,000, since he's spending roughly $35,000 a year. And he'd need to build that nest egg in no more than 25 years. If we plug those figures into a compound interest calculator, we can solve for the required rate of return, which in this case comes out to be about 6.1% per year after adjusting for inflation. We can then look back at history to what combination of investments, when regularly rebalanced, are likely to earn us at least an inflation-adjusted 6.1% over any given 25-year period. Historically, we know that stocks tend to be pretty hard to beat when it comes to long-term returns. On average, the US stock market has earned roughly 10% per year before accounting for inflation. Compare that to bonds, which are a lot closer to the 5% per year return range, or cash, which may get you 1 or 2% per year in returns in some cash equivalents like treasury bills, or maybe 0.5% per year in high-interest savings accounts, or basically nothing in a regular checking account. However, what we also know is that stocks can be quite volatile, especially over the short term. Think of how the stock market performed during much of the 2000s. It's known in investing circles as a lost decade because money left sitting in the stock market during that decade was worth roughly as much in 2010 as it was in 2000, due to the fact that we experienced not one, but 2 market crashes during that time, and thus a lot of volatility drag on our returns. Even if we looked forward to the markets in 2022, following a decade-long market run-up in the 2010s, things don't quite stack up well enough to meet John's goals. From 2000 through the end of 2021, a $10,000 investment into a simple total stock market index fund would have risen in value to approximately $33,300 after adjusting for inflation. That's an average annualized inflation-adjusted return of about 5.6% per year. That's a full half of a percentage point short of John's target after 22 years of investing. And of course, the markets have experienced some volatility to start 2022, so if John had invested all of his money into stocks, things wouldn't be looking so hot right now. However, if he had instead put some of his money into another investment and regularly rebalanced once a year, things may have gone differently. For instance, say that John put half of his money into stocks and the other half into long-term US treasuries. Since bonds are usually considered to be a solid diversifier for stocks, and treasuries are generally seen as pretty safe investments, which is important when we're trying to get a return boost from rebalancing and lowering our overall volatility. From 2000 through the end of 2021, a $10,000 investment into this 50-50 stock-bond mixed portfolio would have grown to be worth around $36,200 after adjusting for inflation. That's an average annualized real return of just over 6% per year, which is still technically just a hair short of our target, but it is at least closer. If we took things a step further and added a third investment to our portfolio, we could have captured a little more of that rebalancing bonus and put John over the top. For instance, say that we added some real estate into the mix. John will put half of his money into stocks, 20% into bonds, and 30% into real estate in the form of REITs. Where does that get us? Well, as it turns out, John's inflation-adjusted net worth heading into 2022 would have been approximately $42,100. In other words, he would have earned an inflation-adjusted return of 6.75% per year. That's above his target, and with some room to spare. However, like I said at the start of the video, there's no free lunch in the world of finance and economics, and rebalancing is no different. As we just saw, diversifying our investment portfolio strategically can give us a boost in overall growth in certain circumstances, and it often raises our risk-adjusted returns because it lowers our portfolio volatility to a larger degree than it usually lowers our returns. But it isn't foolproof. There are potential trade-offs that are being made. The most obvious one is that over the long term, our returns could end up being somewhat diminished compared to an investor who poured all of their money into the highest returning assets. The rebalancing bonus is going to be the most noticeable when the overall returns of each individual asset within the portfolio are fairly similar, and all the assets are highly volatile and negatively correlated. If these factors are not adequately met, then the boost you get from regular rebalancing, while still present, is not going to be quite as noticeable. Let me show you what I mean by running through a few more examples. Over the 2-decade stretch since the turn of the century, stocks have been on a bit of a rocky ride, but they still earn noticeably more returns than treasuries, which will hamper our rebalancing bonus to some degree. And had we been looking at a longer time period, that would have eventually shown up in the results. For instance, had we begun our simulation in 1992 instead of 2000, since 1992 was the start of the 90s bull market for stocks, how far do you think our more diversified portfolio would have fallen behind an all-stock approach, given that we're deliberately starting our examination at the start of one of the strongest decades for stocks over the past century? Think about that for a moment, and keep your guess in mind as we go over the results. Over this time period, our all-stock portfolio would have grown to an inflation-adjusted $117,000. That equates to an annualized inflation-adjusted return of about 8.5% per year. Our 50-50 stock-bond mixed portfolio would have grown to around $94,900. Or at a rate of about 7.8% per year after inflation. So in other words, the rebalancing bonus wasn't enough to make up for the fact that stocks just generally had higher returns than bonds over this time period. Interestingly, our 50-30-20 stock real estate bond approach would have actually grown to nearly $120,000, or at a rate of about 8.6% per year after inflation. So in this case, the rebalancing bonus earned through reducing volatility drag was still enough to overcome the difference in returns between stocks and bonds, however narrowly. Had we split our money up evenly between stocks and real estates in the form of REITs, which during this period produced returns that are more similar to stocks than bonds, the results would have been even better. A 50-50 stock real estate portfolio would have grown to around $130,500, or at a rate of about 8.9% per year. Now, I don't know about you, but when I was first learning about this stuff, this is the part that really blew my mind. Here's why. Individually, stocks grew at an average inflation-adjusted rate of about 8.5% per year. Real estate grew at 8.5% per year as well. Treasuries grew at about 5.7% per year. Did you catch that? Not only does this mean that it is, in fact, possible to devote upwards of 50% of our money towards an asset that grew at a rate that's nearly 3% per year lower than the others, while only giving up about 0.7% per year in returns, instead of the roughly 1.5% you'd expect to give up, but it's also actually possible to outright out-earn any of the individual investments within the portfolio through strategic diversification and regular rebalancing. And we're not just talking about a short-term phenomenon here. This was done over the course of 30 years. What's more is that in every case, we reduced short-term volatility from a standard deviation of roughly 17% for the all-stock approach to as low as 9.4% for the stock and bond approach by more than we did our returns, thereby raising our risk-adjusted returns. The Sharpe ratio in this case rose from about 0.51 for the all-stock portfolio to 0.69 for the stock real estate bond mix, and to as high as 0.78 for the stock and bond portfolio. That's the rebalancing bonus in action. And that added reliability without sacrificing much, or in some cases any, of the long-term returns is just one of the many reasons why intelligent diversification can be so beneficial to investors. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.